Nguyen, Bloomberg FX reporter, and Emma Ross Thomas. She's Bloomberg London bureau chief. Thanks for being with us. Now, let's get investor reaction to the Brexit plan and its impact on the pound. Mark Okada, Highland Capital co-founder and CIO, is with us. He oversees just a mere $17 billion in assets. Congratulations, Mark. So when you wake up this morning as an investor or somebody who's advising investors, how do you react to all this?
Well, it's certainly not a positive as far as we look at the outlook of earnings or what's really happening in the U.S. economy. One of the things that's important about the Brexit move is that it's fueled by populism that's not going anywhere, that really kind of slows globalization. But when that pound moves as much as it is, I mean, that's really a big negative on their economy. It's hard to see how the UK does not avoid a recession from here. And that's a big negative as far as global growth, S&P earnings, a lot of things that we look at.
There's that famous quote from a couple of decades ago from a Clinton advisor that when I come back after life, I'd like to come back as the bond market because it seems to be the most powerful thing on the planet. Yeah. Maybe we should come back as the FX market. Do you think that's had some kind of impact on the government, these kind of rapid moves in sterling? Sure.
I mean, and to that point, right, where are you going to express your bets around the globe? I mean, the currency markets are the largest and most, I think, transparent, although the flash crash was certainly something to worry about as far as that's concerned. But that's a good point.
Mark, to conjecture a little bit, how do you feel this morning if you're Mark Carney? Are you in this race at all? Are you sort of, as they say, hors de combat? If you're off the playing field, do you have a role to play in this?
Well, I think they do. However, I have a different view on really what all of this monetary stimulus has done or not done at this point in the cycle. I think we're very late. We're at the point where monetary policy really isn't helping. You've been decimating your bank stocks and your banks in general, the profitability of your banking system in Europe, in Japan. That's not a positive for the economy going forward. So I think we've got to have a different playbook going forward, and you know, we'll see what happens with that. So to the point, he is kind of on the sidelines at this point.
Well, and the rhetoric was that if you have central banks in there, they're buying corporate debt, no problem, you're going to see yields trend lower. That's not actually happening. Take a look at the Bloomberg here. This charts sterling corporate bond yield. You see a big decline following BOE stimulus, but now we see a rebound. Now we're up to where we were before the stimulus actually happened. Is this the buy what the ECB is not buying scenario?
Well, it's more about risk, okay. Right? Risk is higher. If you have a lower economic projection going forward, then you need to get paid more for that credit per se. And I'm not a big fan of the government's buying corporate debt. I think that's a line that should never be crossed, but it's already been crossed, which is a problem.
It makes things difficult for you, though. You take a company like Apple, a solid company, and its sterling debt rolls over last week, and nothing to do with Apple and everything to do with what's happening with the exchange rate. When you look at UK corporate debt right now, do the moves in sterling scare you away from investing in that debt?
Well, we're a big domestic shop. We don't do a lot of UK sterling debt, and I wouldn't invest in Apple's debt. I'm not sure why they need to borrow per se, except for it's very cheap. The rates are very low. But you know, bottom line, I think what you have to roll all this into is your outlook for the U.S. economy, your outlook for earnings. And I think we have some headwinds going forward. I think 17, if we look at S&P earnings at that start of the year at 144, we're down to 131. I think that continues to get hit, and like it has every year. And you know, we've been flat for earnings on the S&P for 3 years. We're at a 17 multiple. It's hard to see where stocks go up from here, from a fundamental basis, from really any basis. So I don't think we're going to see a whole lot from that standpoint. And that's kind of where the rubber meets the road for us.
We'll continue that conversation. Mark Okada of Highland Capital sticking with us. Let's